Hey everyone, welcome to this explainer. I'm absolutely thrilled to guide you through the most critical business and financial news for the week of July 27th, 2026. We are taking a really fascinating journey today. We're going to start way up at the macro level with some major government shifts from the new Prime Minister, and then we'll zoom all the way down to the micro level, specifically those fast approaching tax deadlines that are going to directly impact your bottom line. We've got a lot of crucial ground to cover, so let's just dive right in.
Here is our roadmap for today. Number 1. Burnham's business agenda. 2. HMRC's plunging performance. 3. Tackling fraud and phoenixism. 4. Trading on private markets. And 5. Crucial tax deadlines.
Section 1. Burnham's business agenda, the balancing act.
Okay, so Andy Burnham's first days as Prime Minister perfectly illustrate the core tension of his new government. On one hand, there is a massive push to ease the cost of living. They're introducing a reduction in VAT on household energy bills and rolling out a single bus fare policy capped at £2 across England starting in January 2027. Burnham is explicitly framing this affordable transport as an essential public service. But, you always have to ask, how is this being paid for? Well, they're diverting hundreds of millions from other budgets, which actually includes international climate finance projects. So, under the guidance of the newly appointed Chancellor, John Healey, who has a reputation for being highly fiscally responsible, the government is really trying to prove it can cut costs for everyday households while still maintaining strict fiscal discipline. Now, how do these macro policies hit the ground for specific sectors? Well, the hospitality industry is getting a major lifeline. They've been promised a 20% reduction in business rates for pubs, clubs, and live music venues in the 2027-28 period, and that actually stacks on top of a 15% relief for this current 2026-27 period, essentially freezing bills in real terms for another 2 years. Do note, though, this excludes the very largest venues. But here is the fascinating twist on how they're funding this. The government is actively targeting businesses that they consider, let's say, not to be making a positive contribution to local communities. They are specifically calling out vape shops as well as non-compliant online sellers. It's a highly targeted shift in the tax burden. While smaller local businesses are seeing those rate shifts, the government is also going after massive international investment. They've just launched a first-of-its-kind advanced tax certainty service. But this isn't for everyone. It's exclusively for businesses planning to invest £1 billion or more in qualifying UK projects. Before they commit that kind of massive cash, this service gives these major investors absolute clarity on corporation tax, VAT, income tax, the whole shebang. It's all about instilling rock-solid confidence to drive massive UK projects.
Moving on to Section 2. HMRC's plunging performance, external examiners mark poor.
You might want to brace yourself for these numbers. The latest annual report from the Charter Stakeholder Group reveals a frankly stunning picture. Out of a 10-point scale, being responsive hit a dismal 2.8. That makes it HMRC's lowest scoring standard for the third year in a row. Making things easy sits at just 3.25, and getting things right actually dropped from last year down to 3.97. What makes this so staggering is that the government committed around $7 billion to modernizing HMRC's computer systems to create this world-class, digital-first organization. Yet the data clearly shows service is actively deteriorating. Taxpayers are constantly citing persistent postal delays and extremely limited expertise when they do manage to get through on the helplines.
And nowhere, absolutely nowhere, is this frustration more apparent than with Making Tax Digital, or MTD. I'll just let this quote sink in for a second. Respondents in the survey called it, at best, poorly designed and generally not fit for purpose. Ouch. Despite HMRC's big push, the overwhelming feedback from small businesses and tax agents is that MTD is uncommercial. It creates totally unnecessary extra costs, it relies way too heavily on software, and frankly, it just completely fails to support the everyday realities of running a small business.
All right, Section 3. Tackling fraud and phoenixism, the Insolvency Service's busy year.
£42.7 million. That is the massive amount the Insolvency Service successfully returned to creditors and the wider economy in the 2025-26 period. They have been incredibly busy. They handled over 11,000 insolvency cases and disqualified over 1,100 directors for misconduct, which represents an 11% increase from the previous year.
When we actually break down where all that enforcement activity is coming from, a whopping 65% of the agency's civil and criminal enforcement outcomes were tied specifically to COVID-19 fraud. That has led to hundreds of director disqualifications and criminal convictions, resulting in actual custodial sentences. However, we have to look at the stark reality behind this massive effort. Despite taking over the recovery of funds lost to COVID-19 fraud back in May 2025 and dealing with a sustained pipeline of really complex cases, only $4.5 million of COVID funds were actually recovered during this period.
Going forward, the agency is locked onto a new primary target: abusive phoenixism. Basically, this is when dodgy directors repeatedly abuse the dissolution or insolvency process. They shut down a company to dodge creditors or commit fraud, and then just pop right back up under a new name. To combat this, the government just announced a massive $25 million investment to fund 50 new staff members entirely dedicated to director misconduct, heavily backed by new artificial intelligence systems. With strengthened data sharing between HMRC and Companies House, they are combining threat assessments to aggressively shut down this specific type of fraud.
Section 4. Trading on private markets, the rise of PISCES.
So PISCES stands for the Private Intermittent Securities and Capital Exchange System. It's a brand new private markets platform, and the early milestones are already fascinating. Fun fact here, the London Stock Exchange was actually beaten to the punch for the very first listing. A British company called J.P. Jenkins listed a board game maker named Qplay as the absolute first company on this new market. But the really huge news involves the autonomous vehicle company Wave. They executed the largest deal so far, with their valuation hitting a staggering $8.6 billion, largely thanks to massive investments from giants like Mercedes-Benz and Nvidia. But it's super important to remember, PISCES is a secondary market only, meaning it's for trading existing shares, not raising brand new capital.
And this, right here, is exactly why PISCES is a total game changer, particularly if you're an employee at a startup. In the old days, you'd be granted share options, often under tax-advantaged schemes like CSOP or EMI, usually in place of a massive salary. Then you just have to wait years for an IPO that might never actually happen to realize any cash. Now look at how the journey changes. Step 1, your options are granted. Step 2, the company holds a secondary trading event on PISCES. Step 3, employees can exercise their options and actually realize cash pre-IPO. It completely solves the liquidity problem for early-stage investors and hardworking staff.
Hold your horses, though. Just a quick word of caution here. It is not quite as simple as just signing up. Joining the PISCES system comes with significantly enhanced governance requirements. For one, businesses will highly likely need to legally update their articles of association. Furthermore, under the employment-related securities regime, having arrangements for shares to be traded on PISCES means those shares will now be viewed as readily convertible assets. That changes the tax circumstances for both the employees and the company, so definitely consult your advisors.
Finally, Section 5. Crucial tax deadlines. Immediate actions required. We are zooming right down to the micro level now. First up, after literally years of intense litigation and political debate, HMRC has finally released new guidance for settling the disguised remuneration loan charge, and the new terms are significantly updated. There's a maximum reduction of the settlement fee of £70,000. All loan charge liabilities get an automatic £5,000 deduction, and really notably, inheritance tax will not be collected where trusts were used. The key takeaway for you here is that HMRC has already started issuing letters. They're going to write and make an offer directly to eligible employees. If you are affected by this, you'll be allocated a specific caseworker to discuss payment plans, and you absolutely must formally sign a legally binding acceptance form to officially close the inquiry.
Next, get your calendars out because we have two very pressing summer dates you need highlighted right now. By July 31st, 2026, the second payment on account for self-assessment is due for sole traders and directors. Remember, if your income has taken a hit recently, you can apply to reduce this or look into a time-to-pay arrangement if you need some breathing room. Then, just 1 week later, on August 7th, 2026, the first Making Tax Digital quarterly update is due for affected sole traders and landlords. This means you have to send your income and expenses for the first 3 months of the tax year directly to HMRC.
Which brings us to our final thought for today's explainer. Are you truly prepared for these upcoming tax deadlines? I mean, considering HMRC's service levels are struggling as much as we saw earlier, you definitely do not want to leave your compliance to the last possible minute. Review your accounts, keep a sharp eye out for those loan charge letters, and make sure your Making Tax Digital software is actually ready to go. Thank you so much for joining me to unpack this dense week of news. Keep learning, stay focused, and as always, ensure your business is staying ahead of the curve. Catch you next time.